Earlier we talked about reducing the income from your gross income, but now we're going to switch subjects and talk about how you can, from your AGI, so now we're going to talk about how you can reduce your tax liability. And so, what do you think when you hear the word credits? What does that make you feel? Does that make you feel good? You hear extra credit, you're like, oh, that's nice, right? When your teacher says, I'm going to give you extra credit, you're like, oh, I want that. So this is going to be the section where we talked about non-refundable credits. So non-refundable credits are a little bit different, but non-refundable credit is a dollar-for-dollar reduction of the tax liability itself. A non-refundable credit can only reduce the tax liability to zero. So, for example, a taxpayer has a tax liability of $1,000, and the non-refundable credit is $1,200. The tax liability becomes zero, and the remaining $200 is lost. So you can only reduce your tax liability to zero. Does that make sense? So this is what it looks like here on Schedule 3, page 2 of your 1040. And where it goes is right. Let's see, back it up a little bit. Right here. So once we calculate how much of your income is actually taxable, we multiply by a percentage to find your tax liability. Your tax liability will go up here at the top on page 2. And then we factor in your non-refundable credits here. And say you have any one of these, it'll start to reduce your tax liability before we get to your other credits. U.S. citizens and residents compute their U.S. tax base on their worldwide income. It just depends on whatever they made throughout the year, like we said. Taxpayers who pay taxes to a foreign country, U.S. possessions may be entitled to credit on their taxes. Just depends if you have stocks in different countries. Taxpayers who receive Form 1099 INT, Form DIV, or Schedule K may have an amount indicated on foreign taxes and have been paid on their behalf from the issuer. So your brokerage will already handle those foreign taxes for you before you even see it.
So if you live in another country and pay taxes to that country, but you're a U.S. citizen, do you have to pay double taxes?
Yes, you have to pay the taxes in that country and then here.
But you get a credit.
Yeah. So the question online was, if you lived in another country, do you have to pay taxes there and here? And the answer is yes, but you can receive a credit here when you pay that tax.
Correct.
So here's a fairly common non-refundable credit, and that's the retirement savings credit that Ms. Fanny had spoken about a little bit earlier ago. Retirement savings contribution credit is a non-refundable credit. Eligible taxpayers can claim this if they made a qualifying contribution to a retirement plan. Does anybody remember what that number was? Yeah. If the contribution is tax deductible, such as your traditional IRA, the taxpayer receives the benefit of the tax deduction and as a tax credit. This is considered a double benefit and is rarely allowed, but it's possible.
It's the only time I've seen it in the tax law. You can get a double deduction. A double benefit.
Yeah. So if you make your contributions to a non-taxable account, such as the Roth IRA, it can qualify as to the taxpayer for the credit as well. So it's beneficial to, it's like an incentive program from the government to say that you're retiring, that you're putting into those contributions. So if you're putting into those contributions, they say, okay, well, we'll alleviate some of the taxes that you may owe. So here is the spreadsheet for how they calculate the amount that's given. based on your AGI. You don't have to remember this. It's just a good little sheet to look at.
Tax layer does it for me.
And TaxSlayer will automatically calculate this. So based on the percentages, this is how you can get entitled to that benefit or to that credit.
So it's a phase out.
Yeah, and it phases out, as you can see, the higher income you have. Because it's really pictured more for low-income individuals to put more into their savings. Does that make sense?
Yes.
Individuals who qualify for the elderly and disabled credit, they have to be age 65. Remember that was one of the questions earlier, or one of the scenarios earlier. Age 65 or older, under the age of 65, retired or permanent or totally disabled, receiving taxable disability income under the mandatory requirement age. So,
These are not.
yeah, so, and we wouldn't worry about these. These are more AARP individuals. So you wouldn't see these too often anyway. It's just another non-refundable credit that does exist. And then we have our next one. This one's actually a really common one. This is our child and dependent care credit. So we're getting into the children. Once we get into these credits, you'll see a lot of how children affect the tax return, and we'll go over them individually. But as for this one, the first one that you'll see is the child and dependent care credit. This credit may be claimed by taxpayer who, in order to work or are looking for work, pay someone or a child care service to provide, to take care of them while they do that. So how does someone claim this credit, or what are we looking for when it comes to receiving this credit? So for a qualifying person, they have to meet a certain criteria in order for an individual to be claimed on the tax return for the dependent care credit. They have to meet the income test. They had some kind of form of income. They had work-related expenses. There's a joint return, and they provide the identification information in order to receive this credit, because that's important. We can't just say, I had my sister's baby cousin take care of him for 2 days while I went to work. No, that doesn't count. You have to be an actual organization or something.
Individual.
You can be an individual, but they would have to be claimed on the tax return. Yes. But for the purpose of this one, you can't just say, I had so-and-so for this many days, but I didn't actually pay them that much to receive the credit. So the credit ranges from 35 to 50% of the taxpayer's expenses. The percentage is based on the taxpayer's earned income and adjusted gross income. The amount of the credit cannot be more than the amount of the income tax on the return. So if it's reduced to zero, then they won't be entitled to a refund. So this is a non-refundable credit, so it can only pay up to a tax liability, and that's it. So if they had $30,000 in child care credit, because it is that expensive now, they can't get the rest of that back as a refund. Does that make sense? So it's a non-refundable credit. So if you pay into your child dependent care credit, it can only pay down your tax liability. It can't pay more than you can't see that money back to you. Some taxpayers receive child and dependent care benefits from their employers, and that will be indicated on their forms, on their W-2 forms. All payers who receive the employer-provided dependent care benefits are required to complete an additional form 2441, Part 3, to determine if they can exclude all or part of the benefits from their taxable income. The credit is limited to $3,000 for one qualifying person or $6,000 for 2 or more qualifying persons. And so this is again showing you page 2 of your 1040 or Schedule 3 for the non-refundable section. These are all the different types of non-refundable credits that exist. This one being a big one. We'll get into the education credits. There's a retirement savings credits that we just spoke about. There's energy efficiency credits, This one is very convoluted, so I don't know if we speak on that.
Which one?
The energy efficiency.
Oh, no, we don't do it.
Yeah, we don't worry about those, but some individuals will come in with those. And
I think that's about it.
yeah, that's about it. And then there's some other ones as well. So then we have our second type or our third type of non-refundable credit, and that is the child tax credit, the non-refundable portion. So that's the second or the third way that a child impacts a tax return, and that is you get another credit, which is the non-refundable tax credit for child tax credit. So how does a child get qualified for the child tax credit? The qualifying child has to be under the age of 17 at the end of the year, a U.S. citizen or U.S. national, resident alien, can be claimed as your dependent. They must be your son or daughter or adopted child, stepchild, eligible foster child, or any descendant of them. They can be your brothers, half-sisters, stepbrothers, stepsisters, or descendants. Did not provide over half his or her own support. That's very important. Live with the taxpayer for more than half of the tax year, so more than 6 months. Must have a Social Security number that is valid for employment issued before the due date of the return. So the non-refundable credit for the child tax credit is a $500 credit for other dependents who do not qualify for the child tax credit. The dependent must, this is another credit, I misspoke. The non-refundable credit for other dependents is another tax credit, so if you're not a child tax credit for the non-refundable, there's another credit for people that are over the age of 17, and that is the non-refundable, that's the credit for other dependents, which is a non-refundable credit. And this one is the $500 non-refundable credit. And so this is for individuals who are over the age of 17, still being claimed as a dependent.
Can we go back to the child tax credit and the dependent credit? Now, the child and dependent credit, well, the child tax, they're two different credits. They seem very similar. One is for child and dependent child care tax credit, and the other one is the child tax credit. Now, part of the child tax credit can be a refundable portion, and we will talk about that when we get to refundable credits. But the dependent and child tax credit, none of it is refundable. But for that child tax credit, a portion of it could be refundable. But you don't have to worry about it. Taxpayer is going to figure it out based on the information that you input into the system.
Yes.
The
So,
program.
yeah. So all of these credits that we're talking about are separate credits that do different things. So there's the non-refundable portion. So we had the child independent care credit. We had the non-refundable child tax credit, and then we had the credit for other dependents, which is a non-refundable credit as well.
And I know it kind of sounds confusing, but based on the information that you input into TaxSlayer, it's going to figure all this out for you.
All right, so here is another common, and this one actually pertains to you guys, and that is an education credit, of which there are two. There are the American Opportunity Credit, which is the big one, which is really nice, because this is the one that you get 40% of it is refundable. And then we have the Lifetime Learning Credits. Both of these we will talk about and how you qualify for each one. So the education, taxpayers can take education credits for themselves, their spouse, or their dependents to be claimed on their tax return who are enrolled or attended an eligible post-secondary educational institution during the tax year. An eligible institution is generally any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary institutions eligible to participate in a student aid program administered by the United States Department of Education.
It's J1.
And page J1 in your Pub 4012. In your Pub 4012, it has a good little chart. I don't think it's in the slides. Oh, here it is. And it kind of tells you the differences between each one of these. This is a good one to recognize and to see because it also gives you the values for each as well. And the two most important are the American Opportunity, the Lifetime Learning, and we will speak about the student loan interest deduction as well. But I think you did that.
I did.
Okay. So for the American Opportunity, let's look at the benefits. What are the benefits of the American Opportunity Credit? Credits can be reduced the amount of the tax you have to pay, and 40% of the credit may be refundable, and it's limited to $1,000. Wow, so all that money you pay to school, you can get some of it back. Isn't that nice? What's the annual limit? $2,500 credit per student. 100% of the first $2,000 plus 25% of the second $2,000 of the qualified expenses. So when you guys get your W-2s for, your 1098-Ts for school, if they indicate on their intake sheet that they went to school, the 1098-T is the second thing we want to see because we want to say, okay, what happened when you went to school? How much did you pay when you went to school? Did you have any scholarships, grants, Pell Grants? And that'll all be indicated on the 1098-T form. And then you also have the Lifetime Learning Credit. And so this one is, there's limitations for the American Opportunity Credit, and that is that you're pursuing your undergraduate degree, and it can only be claimed 4 times. So, all your 4 years that you're actually at the university is when you can actually claim that credit. And afterward, if you're going for your doctorate or you're doing your if you're doing your doctorate or your master's degree, or you're going for just to improve your life skills, the Lifetime Learning Credit is the one that you would take. And that one only just reduces some of the taxes that you pay. So it just says, hey, government, I went to school just to improve my job skills. Can you just be easy on my tax liabilities? And the other says, hey, I'm pursuing my undergraduate degree. I would like to see a little portion. Can you be easy on my taxes? Or I paid for my son or daughter to go to school. Can you be easy on my taxes? And I would like to see a little bit of it back. Does that make sense? Does everyone understand the difference between the American Opportunity and the Lifetime Learning Credit? Cool. So like we spoke about, what are the qualifications for the American Opportunity Credit? There are a few. When you go into the software, it'll have you answer a couple questions, and you'll answer all of these questions for if they are eligible for either one. So the system will ask you these questions to verify that they actually qualify for these credits. So what are the qualifications? Taxpayers claiming the credit have to be under the age of 18 or 18 at the end of the year, and their earned income was less than 1/2 of their own support, or full-time student over the age of 18 and under the age of 24, and their earned income was less than 1/2 of their own support. So they can be under the age of 18 or up to the age of 24 in order to claim this credit, and did not provide more than half their own support. Taxpayers has at least one living parent, or taxpayer doesn't file a joint return. So they can do, and so those are some of the qualifications. Let's see if they have the others. There are some more questions that ask if you had a felony conviction, you're not allowed to have it, and things of that nature. So this is what your 1098-T looks like. How many of you guys have received one of these or have seen one of these before? Should be all of you. Or is this your first year? So At the end of each year, your school institution will give you this form. It's the 1098T. When we see this form, there's two things that we have to do. One, we want to see this form. And then two, we're going to check some things. One, we're going to check this box here, which is the scholarships and grants. This will tell us how much scholarships that you actually received through your institution. And then secondly, we'll be checking this box one, which is your actual expenses. We'll do a little bit of math. I think this is the only time that you actually have to do some math. Is we'll take this qualifying scholarships and grants and we'll less it from your actual expenses to calculate the amount that was actually out of pocket. We'll also add in a few extra expenses, and I think that's the next slide, so I won't mention them just yet. And then we'll also be checking this too. These boxes down here. If you said, okay, I went to school, I'm trying to get the American Opportunity Credit, but they finished their undergraduate, do you think they qualify for the American Opportunity? No, because it'll check that they're a graduate student. So what credit do you think they will be entitled to? The lifetime, correct. So the Form 1098T, Box 1, may include the non-taxable scholarship grants amounts. Some students may choose to pay non-qualifying expenses with the scholarships and Pell Grants funds. And like we said, in Box 5, it would be indicated back on this form in the scholarships and grants section. It's best that you guys give copies to your parents or for yourself, and we'll make the determination at all of our locations. So if we see the form, we'll make sure, we'll double check. If you don't have the form, we'll have you log in, and we want to look at it because it's a good credit, especially the American Opportunity, if you're entitled to it, or the lifetime. So here's a poll question.
Before you go to that, you might want to let them know that the American Opportunity Credit, part of it could be refundable.
Yes. Well, that goes back to here. And so that's why it's really beneficial for a lot of people who go to schools, because a portion of it is refundable. Because you guys spend a lot of money going to school, so it's good for a lot of individuals to get some of that money back that they spent in school. Yes, sir.
I do have two questions. On the expenses, so like say I'm a transfer at community college, I paid for all of my school. Does that differ on like taking student loans and as far as like expenses go? Like, how does that reflect differently? Like if you're actually paying out of pocket for school as opposed to now having student loans and not really paying for it yet, does it need to wait until you're actually paying for it?
Okay. Student loans
Yeah, it's still-
considered like your money.
Yeah, right, so it does count as your.
Correct.
Yep.
Okay, that's what I thought.
So the question was online is if they pay through student loans, does it still qualify? And the answer is yes.
I'm sorry?
One of the qualifiers is up to like 24, so if you're like a non-traditional student, you don't qualify for American Opportunity. I think I saw that. I think it was like 18, over 18 and under 24. So do you not qualify for American Opportunity if you're a non-traditional student?
That's correct.
Right.
Yes. Well,
You might still get it, but it won't be refundable.
Yeah, you
Yeah.
might still get it, but it won't be refundable.
yeah, it'll only
Okay.
be, yeah.
Okay.
And we make those determinations because my first year as a site manager at TCC, I had a lot of people who were still trying to figure out life and just try to take a couple classes. I had to sort this out at almost every tax return to see, is it in your best interest to start taking your American Opportunity Credit? Like we said before, you only have 4 times to claim the credit. And if you're going to junior college, but you haven't sorted out your major or you're just taking classes, it won't be in your benefit to actually take the American Opportunity Credit until you're ready to actually start paying for those larger expenses. Good question, though. We'll skip that one for now. Jose and Yolanda are married, filing jointly, and have 5 dependent children under the age of 17. Jose and Yolanda both have valid Social Securities. The children have individual tax identification numbers. Are their children qualifying children for the purposes of the child tax credit? Who says yes? Show of hands. Who says no? I'm going to say no. The children do not qualify for the child tax credit because they do not have valid Social Security cards or Social Security numbers. They do qualify for children credit for other dependents, though. Yes, sir.
For the child tax credit, do you need both taxpayer identification and Social Security?
Yeah, they need to have socials in order to claim the credit. All right. Bob was a full-time student and a fifth-year senior. He has only claimed the American Opportunity Credit for 3 earlier years. Does he qualify for the American Opportunity Credit? How many people say no? How many people say yes? Yes, the answer is yes. Bob qualifies because he hasn't used it all 4 years. All right. Janice works full-time and takes 1 course a month at night school. Some of the courses are not for credit, but they are meant to advance her career. Which credit is appropriate for her? Yes, sir.
Say lifetime learning.
Who says lifetime learning? That is correct. It's the lifetime learning credit.